More than 90% of Americans should wait until age 70 to claim Social Security. That is not an opinion. That is the conclusion of researchers at the National Bureau of Economic Research after analyzing the financial data of millions of households. And yet only 10% of Americans actually do it. The rest file early, and the median cost of that decision is $182,370 in lost lifetime benefits. Per household, gone permanently, not because of a scam, not because of a market crash, because of a single date written on a government form. If you are anywhere between 55 and 67 years old right now, this video could be the most important thing you watch this year. Because once you file, the clock cannot be turned back. This video is for educational purposes only. I am not a licensed financial advisor, insurance agent, attorney, or tax professional. Everything discussed here is general information. Please consult a qualified professional before making any financial, insurance, legal, or tax decisions. Let us start with the number the Social Security Administration publishes openly, and that almost nobody actually stops to calculate for their own situation. In 2026, if you claim Social Security at 62, the earliest possible age, the maximum monthly benefit is $2,969. If you wait until your full retirement age of 67, that maximum climbs to $4,152. And if you hold on until age 70, the latest age at which your benefit keeps growing, it reaches $5,181 per month. Those are official SSA figures. That gap between 62 and 70 is $2,212 every single month. Every month, for life. Adjusted upward every year by cost of living increases stacked on top of that higher base. Now, most people are not maximum earners, but the percentages apply to every single person equally regardless of what they earned. If your full retirement age benefit would be $2,000 a month, claiming at 62 drops that check to $1,400. Waiting until 70 raises it to $2,480. That is a difference of over $1,000 every month, $12,000 every year, and it never reverses. It is locked in for the rest of your life. Here is the mechanism that creates this, and understanding it is what makes the whole picture clear. Social Security has what is called a full retirement age. For anyone born in 1960 or later, which covers the vast majority of Americans approaching retirement right now, that age is 67. You can claim as early as 62, but the system permanently reduces your benefit for every month you file before that age. The reduction formula is precise. 0.05% for each of the first 36 months you claim early, and 0.05% for each additional month beyond that. For someone filing exactly at 62, 60 full months before their full retirement age, the total permanent reduction is exactly 30%. Not 30% for a few years, 30% for as long as you live and collect that check. On the other side, if you delay past 67, the Social Security Administration adds what are called delayed retirement credits. For every year you wait between 67 and 70, your benefit grows by 8%. 3 full years of delay equals a 24% permanent increase above your full retirement age benefit. And just like the early penalty is permanent, this increase is also permanent, compounding into every cost of living adjustment for the rest of your life. Now here is what I want you to stay with me for, because this next part is what changes the way most people think about this entirely. The NBER research I mentioned in the opening did not just look at claiming ages. It calculated the actual lifetime financial damage from claiming too early. The median American household, according to that research, loses $182,000 in lifetime benefits by not making the optimal claiming decision, nearly $200,000. That is not a theoretical number. That is what researchers calculated as the real-world median loss, the middle of the distribution, not the worst case. And here is the part that should stop you cold. 70% of Americans already know their payments would be larger if they waited. The Schroders U.S. Retirement Survey found this directly. 7 in 10 people already understand the rule. They just are not following it. When researchers asked why, the answers were telling. 37% said they simply want the money now. 36% said they are afraid Social Security will run out of money. 34% said they need the income to survive. Those are real reasons. And the third one, needing the income, is genuinely valid for many people. But the first two reasons cost Americans hundreds of thousands of dollars in total lost retirement income every single year. And both of them are driven by a misunderstanding of how the system actually works. Let us talk about the fear of Social Security running out, because this one is especially important. Yes, the Social Security Trust Fund faces pressure. Under current projections, if nothing changes, there could be a benefit reduction in the early to mid-2030s. But here is what most people do not realize. Even if no reforms are passed, ongoing payroll taxes would still fund approximately 75 to 80% of scheduled benefits. The program does not disappear. It does not go to zero. A possible reduction of roughly 20% sometime in the future is not the same thing as your benefits vanishing. And critically, the 24% increase you earn by waiting from 67 to 70 is larger than the worst-case projected cut. The math still favors waiting for most people, even accounting for that risk. Now let us get into the factor that almost nobody calculates before they file, and this one is especially powerful if you are married. When the higher-earning spouse delays their Social Security claim and locks in a permanently larger benefit, they are not just protecting their own monthly income. They are setting the foundation for survivor benefits. When one spouse dies, the surviving spouse receives the higher of the two benefits, not both. If the higher earner filed at 62 and locked in a 30% reduction, that smaller reduced check is what the surviving spouse collects for the rest of their life, potentially for 20 or 30 more years. The decision one person made at 62 about which box to check on a government form shapes another person's financial reality for decades after they are gone. There is one more rule that surprises a significant number of people who file early while still working. If you claim Social Security before your full retirement age and you continue to earn income from work, the Social Security Administration may temporarily withhold a portion of your benefit. In 2026, if you are under your full retirement age for the entire calendar year, $1 in benefits is withheld for every $2 you earn above $24,480. That limit is confirmed directly by the SSA. In the year you actually reach your full retirement age, a more generous limit applies, $65,160, and the withholding rate drops to $1 for every $3 above that. The moment you reach your full retirement age, this test disappears entirely. The withheld amount is not permanently lost. The SSA does recalculate your benefit upward after you reach full retirement age to credit you for withheld months. But the process is complicated, and many people filing at 62 while still earning income do not account for this at all until their check arrives smaller than expected. Here is a number that puts everything into perspective. The average Social Security check for a retired worker as of April 2026 was $2,081 per month, according to the SSA's own monthly statistical data. That is the real-world average. Now look at the gap between what someone collects at 62 versus what they would collect at 70. For the average earner, that difference is well over $1,000 every single month. And that gap grows every year through cost of living adjustments, because the adjustments are applied as a percentage of whatever base amount you locked in. A larger base means larger adjustments every single year for as long as you live. The decision of when to claim Social Security is not a simple form you fill out and forget. It is one of the most consequential financial decisions of your entire retirement, precisely because it cannot easily be undone. You do have one window. Within 12 months of your first payment, you can withdraw your application and repay everything received, effectively resetting your claim. But after that window closes, the amount is locked in. Here's what every person in or approaching retirement needs to do before filing. Go to ssa.gov and create or log into your free My Social Security account. Your personal statement is there. It will show your projected monthly benefit at 62, at your full retirement age, and at 70, calculated from your actual earnings record. Run those numbers. Calculate the monthly gap. Then calculate how that gap compounds over 15 or 20 years of retirement. Then, and only then, make the decision knowing exactly what each date on that form is actually worth. Because the form itself looks the same regardless of which age you write on it. The difference is only visible in your bank account every month for the rest of your life. This video is for educational purposes only. I am not a licensed financial advisor, insurance agent, attorney, or tax professional. Everything discussed here is general information. Please consult a qualified professional before making any financial, insurance, legal, or tax decisions. 90% of Americans would benefit from waiting. 10% actually do. The question is which side of that number you want to be on, and whether you made that decision with the full picture in front of you.